Silver isn't just beating gold right now. Silver is exposing where the market is actually tight. That's why traders are watching it like a hawk. Because the story most people are repeating is comfortable. Gold is the safe haven, silver is the noisy little brother. But the tape is telling you something sharper, something mechanical. And if you catch it early, you'll know what matters over the next 1 to 2 weeks, what levels decide the next leg, and what breaks the whole setup if this is a fake out. Here's the conflict. Every time silver starts to outperform, a lot of voices rush in to explain it away as hype, meme energy, or just a leverage tantrum. And yes, silver can absolutely do tantrums. But that's not the part that matters. The part that matters is what silver's outperformance forces the market to do behind the scenes, in futures, in options hedging, and in physical sourcing. And that's where the real pressure starts. Zoom out just enough to see the shape of the move. Early January prints had silver in the low 70s, and within days it was ripping into the 80s, then tagging the low 90s around mid-month. Gold moved too, but it moved like a heavyweight, steady, heavy steps, while silver moved like a blade, fast and violent. That difference is not cosmetic. That difference is market structure. Silver is not simply going up, it's moving in a way that changes risk systems, margin, dealer hedges, and the behavior of anyone short volatility. And the next detail is what flips the whole setup. Traders don't just watch the silver price. They watch the scoreboard between silver and gold. Because that ratio tells you when the market stops treating silver as a side quest and starts treating it as the main event. The gold to silver ratio is the simplest, most brutal signal. One number. It basically asking, how many ounces of silver does it take to buy 1 ounce of gold? When that ratio falls, when it compresses, silver is outperforming. And in the first half of January, that ratio didn't just drift, it tightened meaningfully as silver ran harder than gold. That matters, because big money doesn't only think in up or down. Big money thinks in relative value, and spreads, and pairs, and what can be hedged. If you're a macro allocator, you don't always want raw direction. You want the trade that pays you for being right faster. Silver outperformance is that trade. But here's the trap. Silver can also punish you faster. So the same ratio compression that attracts flows also attracts volatility. And that volatility is not random. It's often forced. You've probably felt it if you've watched the candles. Silver spikes, then it dumps. It looks like someone hit it with a hammer, then it recovers like nothing happened. That's not just emotions in the crowd. That's how leverage behaves when the underlying is thin, when options are active, and when margins are being tightened. Silver is getting more expensive to trade for a reason. Exchanges raise margin requirements when volatility rises, not to stop a move, but to control systemic risk when swings get large. And if you think that doesn't matter, it matters immediately, because margin is the hidden throttle on speculation. When margin goes up, some participants have to post more collateral or reduce exposure. Translation: even in a bullish trend, you can get sudden ugly flushes simply because someone's risk manager hit reduce. But that's not the whole story. Because if this one level breaks, the math changes. The move becomes less about who wants to buy and more about who is forced to buy. Now here's the hidden detail that reframes everything, and it's not glamorous, but it's the difference between paper noise and real tightness. Now, people love to say, there's plenty of silver inventory. They'll point to big headline numbers in warehouses or ETFs and declare the squeeze narrative dead. But inventory is not the same thing as deliverable supply. It's not even close. In the futures ecosystem, a chunk of metal can exist in the system and still not be available to satisfy delivery without the owner choosing to make it available. That's the core distinction between metal that is simply sitting there and metal that is actually registered and deliverable against contracts. And that gap is where silver becomes dangerous. Because when deliverable supply is tight relative to demand for immediate settlement, the price action you see can look irrational until you realize the market is repricing time and availability. And that's when spreads start screaming. This is where we shift shape for a second, away from story into mechanics. Silver trades in layers. You've got spot pricing that reflects the global benchmark. You've got futures pricing that reflects time financing storage and demand for forward exposure. And you've got the physical market where bars and coins and industrial inputs actually have to move through refineries, mints, and supply chains. When everything is calm, those layers line up neatly. When stress enters, they don't. The paper versus physical tension isn't a conspiracy, it's an incentive mismatch. Futures can create huge exposure instantly. Physical metal can appear instantly. Refining capacity, logistics, and fabrication are real constraints with lead times. And silver is uniquely vulnerable here because it's not just a monetary metal like gold. It's also an industrial input. It gets used up. Some of it returns via recycling, but not all of it, not quickly and not in the form you need, when you need it. That's why, in tight conditions, the market starts paying for immediacy. And the way you detect that isn't only by staring at the headline price, It's by watching the curve. The curve is the truth serum. Look at how near-month silver contracts trade versus contracts further out. In a relaxed market, the futures curve often reflects carrying costs and normal financing. Later months might be a bit higher than the front. But when the front end gets tight, when people want silver now, the front can trade rich relative to later months. That's backwardation pressure, and it's a signal that immediacy is being priced. Now, I am not telling you the curve will stay that way forever. Silver can snap back hard when fear cools. But when you see the front end bid and the market resisting selling pressure, that's the market telling you this move isn't purely sentiment. It's supply and timing colliding with leveraged exposure. And the next detail is what flips the whole setup. Timing is not a vague idea in futures. Timing is a calendar with deadlines. This is why the why now trigger matters so much, especially in January. We're in a window where month-end flows, delivery-sensitive positioning, and the approach to first notice periods force decisions. Futures aren't just lines on a chart. They're obligations with a schedule. As we push toward the end of January, traders who are long front-month exposure have to decide whether they're rolling, standing for delivery, or closing. Shorts have to decide whether they can source deliverable metal or whether they need to buy back risk. And when liquidity thins, especially around weekends, around month end, and in a market already stretched, these decisions can show up as violent price moves. That's why I'll often see silver do its most dramatic work when the calendar tightens, not when the headlines are loudest. Everyone's watching the headline, but the signal is somewhere else. It's in spreads, in rolls, and in what participants are forced to do under deadline. Now let's start stacking proof, because one argument isn't enough in a market like this. Proof point one is the relative performance itself. Silver beating gold during a period when both are strong. That tells you investors aren't just hiding in safety. They're reaching for torque. Proof point two is volatility behavior. Silver ES implied volatility has been elevated enough that it ES become a story in its own right. An elevated implied volatility changes everything. It changes option pricing, it changes dealer hedging, it changes how quickly a move can feed on itself. Proof point three is margin behavior. When an exchange hikes margins in a fast-moving market, it's an admission that the distribution of outcomes has widened. It's risk management reacting to realized chaos. And that matters because it creates forced sellers on dips, exactly when bulls want to buy. It also creates forced buying on rallies, exactly when shorts want to hold their ground. That's a recipe for whipsaw, not because they want it, but because the system is built that way. Proof point four is the retail versus institutional divergence you can feel on the ground. In past big silver runs, retail can get euphoric and chase. But there's also evidence that at points in this rally, a chunk of US retail flow has been more sell than buy. People taking profits, liquidating coins, dealers reporting more sellers. That is the opposite of what a pure retail mania looks like. It suggests the marginal buyer isn't only the guy shouting on social media. It hints at deeper allocation, overseas demand, institutional positioning, and industrial procurement dynamics that don't show up in a meme narrative. And that's where the real pressure starts, because institutional flows don't need to be loud to be heavy. They just need to be consistent. Proof point five is industrial reality. Silver is not optional for large parts of the industrial system. Solar, electronics, electrification. Silver is part of the plumbing. Can users thrift it? Sometimes. Can they substitute instantly? Not always. And when prices surge, the first reaction is rarely, we can quit. The first reaction is, we have to secure supply and manage price risk. That means procurement and hedging. And procurement and hedging flow into futures and options, which feeds right back into the structure we've been talking about. That's reflexivity, not vibes, math. So let's make the math plain without turning this into a textbook. Here is the simple options loop. When a lot of call options get bought, especially near the money, dealers who sell those calls often hedge their risk by buying the underlying exposure. In futures, that can mean buying silver futures. As price rises, the hedge requirement can increase, which means more buying, which can push price higher. That the gamma effect in human language, price rises can force more buying from the entities hedging the options they sold. This can create a feedback loop in a market that's already moving. It doesn't guarantee a squeeze, but it can turn a normal rally into a rally that feels like it's slipping out of everyone, as hands. And that's why silver moves can look unreasonable for a while, because the flow is mechanical, not deliberative, but that's not the part that matters. The part that matters is what happens when the loop meets the real world, deliverable supply, rolling pressure, and margin. Now, pattern interrupt, quick calculation, because it anchors reality. If silver is printing in the high 80s to low 90s, and gold is printing in the mid 4000s, that ratio can compress into the low 50s, or even flirt with the 40s if silver keeps leading. That's not just trivia. Funds that watch that ratio see it as a reversion and momentum signal. If the ratio falls quickly, it can trigger systematic behavior, rebalancing, relative value trades, and momentum strategies that keep the bid under silver. And now you've got a market where silver ES outperformance doesn't to just attract discretionary bulls. It wakes up systematic money. That's when moves get persistent, and that's where the real pressure starts. But we have to respect the counterpoints because silver punishes certainty. Counterpoint 1, this could be late cycle blow-off behavior. When a commodity goes vertical, the next move is often not another straight line, it's a pullback that tests conviction. Counterpoint 2, demand destruction is real. At some price level, some industrial users reduce, delay, or redesign. It doesn't happen in a day, but it happens. Counterpoint 3, policy and rates can change the macro wind at your back. If real yields spike or the dollar catches a sudden bid, precious metals can get hit even if the longer-term thesis remains intact. Counterpoint 4, leverage can unwind. If volatility remains high and margins rise again, you can get liquidations that look like the move is over, only for it to stabilize later. And the next detail is what flips the whole setup. You don't need to predict which counterpoint wins. You need a framework that tells you what's signal and what's noise. Here's the viewer psychology shield, because the market will try to use your emotions against you. Silver doesn't climb like an escalator, it climbs like a staircase in an earthquake. You will see fast green candles that trigger FOMO, and you will see sudden red candles that trigger shame and panic. The manipulation isn't a secret cabal. The manipulation is volatility itself. Volatility compresses your decision time. It makes you feel like you must act now. That's how people buy tops and sell bottoms. The defense is simple. Separate trend signals from noise and commit to watching objective tells instead of feelings. Trend signals. Higher highs and higher lows on a time frame that matters to you, stability after spikes, and a curve that stays firm rather than collapsing. Noise. Intraday whipsaws that occur when liquidity is thin, especially around weekends, around key deadlines and after margin changes. If you can't tell the difference, silver will teach you expensively. So what do you watch, specifically, over the next week or two? First, you watch the recent high zone. Silver tagging the low 90s is a statement, but the market doesn't just ask, can we hit it? The market asks, can we hold above the broken ceiling? If silver can hold above the upper 80s after a spike, if it can absorb selling and still close strong, that's confirmation. If it loses that zone and starts closing below mid-80s with speed, that's warning. Second, you watch the mid-80s region as a pivot. In a fast market, pivots matter more than precise single numbers. A stable base in the mid-80s suggests a controlled pullback and retest. A failure through that area suggests the move is being delevered. Third, you watch the breakout origin zones in the high 70s to low 80s. If silver flushes down there and finds aggressive buying, especially if the curve stays firm, that can be a bullish reset, not a collapse. But if it breaks those levels and stays heavy, then the thesis weakens in the near term. Because if this one level breaks, the math changes. You go from trend with volatility to trend in doubt. Now bring gold back into the frame because silver doesn't trade in a vacuum. Gold is the anchor and silver is the lever. If gold holds firm while silver corrects, silver can reset and run again. But if gold rolls over hard at the same time silver is extended, silver can get punished twice, directionally and via leverage. So watch gold's behavior around its recent highs. If gold remains resilient, if it grinds instead of dumping, that gives silver room to remain the outperformer even through pullbacks. If gold starts losing key support zones, silver's volatility will likely amplify the pain. That's not pessimism, that's structure. And now the calendar again, because this is not optional. Month-end matters. Delivery-sensitive windows matter. Thin liquidity matters. In the run-up to those deadlines, you can get squeezes and you can get traps. A squeeze looks like this. Price pushes above a recent high, shorts scramble, dealers hedge calls, and the market gaps because liquidity can't absorb urgent buying. A trap looks like this. Price spikes into a known liquidity pocket, then reverses violently as profit takers hit the bid and leverage gets cut. Both can happen in the same week. That's why your job isn't to predict a straight line. Your job is to know what each move forces participants to do. If price is rising and the curve is staying firm, someone is paying up for time and availability. If price is rising but the curve collapses and volume feels exhausted, the move is more fragile. If price is falling but spreads don't blow out and buying shows up quickly, the pullback is likely just de-risking. But if price is falling and everything starts to loosen at once, spot, curve, and sentiment, that's when you respect downside. Let's talk about the paper versus physical. Tell without making this weird. Physical markets have symptoms. Premiums can widen. Availability can tighten. Dealers can report different flows. Industrial buyers can quietly hedge more aggressively. None of these alone prove anything. But when several line up with future structure signals, when you see front-end firmness, high volatility, and the ratio compressing, then the probability that something real is happening goes up. Not certainty, probability. That distinction is everything in risk management. You don't need a guarantee, you need an edge with a plan. And the next detail is what flips the whole setup. The plan has to include invalidation, not because you're bearish, because you're serious. So here's the two scenario lens, clean and usable. Scenario 1 is the controlled pullback and retest. In this scenario, silver cools from the low 90s, tests the upper 80s or mid 80s, shakes out late longs, then stabilizes. You'll see smaller candles, you'll see dip spot, you'll see gold steady. I'll likely see the ratio stop compressing aggressively but remain supportive, meaning silver holds relative strength even during the pullback. That's the scenario where patient positioning wins and FOMO loses. Scenario 2 is the continuation squeeze. In this scenario, silver doesn't give you the clean retest. It holds firm, liquidity thins, and it pushes back through recent highs with urgency. That's where you get gaps. That's where you get intraday surges that don't look reasonable. That's where you see the market reprice volatility again and punish anyone underhedged. The tell is speed plus persistence. It's not just a spike, it's a spike that doesn't get fully sold. And if that happens, the psychological level everyone will talk about is 100, because round numbers are magnets in a narrative market. But you don't trade the narrative, you trade the mechanics. The mechanics are, if price is accelerating into 100 with options activity and hedging pressure, dips may become shallow and violent. But the risk is also higher, because once the mechanical loop exhausts, the reversal can be just as brutal. Now, one more reality check on volatility, because this is where viewers get wrecked even when they're right. You can have a correct long-term thesis and still lose money if your time frame and position sizing don a T-match silver-ass behavior. Silver can drop hard in an uptrend. It can do it in hours. It can do it on no news. That doesn't mean the thesis is dead. It means the market is clearing leverage and testing resolve. So your risk framing has to be explicit. This can whip around violently even if the bigger story remains intact. If you're trading, you need defined risk and you need to respect your stops. If you're investing, you need a time frame and you need to avoid making decisions in the emotional center of the storm. The market will try to make you confuse motion with meaning. Don't let it. So what's the hidden mechanism that mainstream misses? The one that makes silver's outperformance more than a headline? That silver as S market structure makes it prone to forced behaviors when deliverable supply constraints meet leveraged exposure. The deliverable versus not deliverable distinction means inventory can look ample while immediate settlement tightens. The futures calendar forces decisions at specific times. The options market can force hedging flows that amplify moves. Margin policy can force liquidation and then create vacuum rebounds. And the gold-silver ratio acts like an amplifier switch, pulling in relative value flows when silver starts to lead. Put those together and you don't need a fairy tale. You get a coherent machine, and that machine is exactly why traders are watching closely right now. If you want a near-term checklist you can actually use, here it is in plain language, stitched into the flow. First, watch whether silver can stay constructive above the mid-80s after volatility spikes. Second, watch whether the low 90s area acts like a ceiling that rejects price, or a ceiling that becomes a floor after a retest. Third, watch gold for stability. If gold stays firm, silver has room to remain the outperformer. Fourth, watch the curve and the feel of the front end. If the front stays firm relative to the back, the market is still paying for immediacy. Fifth, watch volatility and margin headlines, not as manipulation, but as the system's risk gauge. Higher volatility means wider ranges, and wider ranges mean your plan matters more than your opinion. And finally, watch the ratio. If the ratio keeps compressing, it's telling you silver's leadership is still intact. If the ratio snaps back hard, it's a warning that gold is reclaiming the wheel and silver may be de-levering. And here's the subtle part most people get wrong. You don't have to be all in bullish to benefit from understanding this. You can be skeptical and still respect what the structure is signaling. In fact, skepticism is useful here because it keeps you from confusing momentum with inevitability. Silver can absolutely be overextended, but overextended markets don't always reverse immediately. Sometimes they churn, sometimes they consolidate and reload. Sometimes they squeeze higher before they breathe. That's why the only sane approach is a scenario map plus invalidation, not a prophecy. If you're the kind of person who wants mechanics over hype, who wants to know what forces participants to do what matters on the calendar, what levels decide the next move, and what would actually break the thesis, then you're in the right corner of this market. Because the goal isn't to win an argument on the internet. The goal is to stay solvent, stay sharp, and recognize when the market is quietly telling you the truth through structure instead of headlines. And in a moment where silver is outperforming gold, volatility is elevated, and deadlines are tightening, the truth is simple. This isn't emotion, it's math. And the next 1 to 2 weeks will tell you whether that math is building a base for the next leg or burning itself out in a squeeze that leaves a crater behind.